In this presentation, we will work a problem for the Capital Projects Fund and the government-wide activities, focusing in on the different forms of financing, how to record them in the fund accounting, modified accrual, and government-wide activities accrual basis. Information will be on the left-hand side. We're going to enter that information into the blue areas on the right-hand side. We will journalize the journal entries and then post them to a worksheet which will have a trial balance, adjustments, and then the ending balance, so we can see the activity and how the accounts behave. The trial balance will be in order: assets in green, liabilities in orange, and then what would be the equity section, assets minus liabilities section, the fund balance section in light blue, and then what would be the income section in a for-profit organization. They're going to be the accounts that close out, typically temporary accounts, going to be in the dark blue down below. Same kind of process for the government-wide activities, where we're going to record the journal entries, post the journal entries in a similar fashion. Back to the data, let's see what our first item is. Secures a note payable to pay for construction project. So we have a note payable. We're going to pay back this note payable in 2.5 months. Let's first record it in the government-wide activity. That's going to be more on an accrual basis, what we would expect. And then we'll come back to the Capital Projects Fund, which will be more on a modified accrual basis. Or it will be on a modified accrual basis, which is less what we're used to, most likely. So we're going to be back over here in column O. We're in the government-wide accounts, government-wide activities, and we're going to get cash. That's going to be the first item. Cash is cash, so we're going to say cash is going to increase with a debit. And the other side, it's a note payable. It's just going to be a credit to some type of liability, note payable. Nothing unusual there. That would be the normal kind of process if we were to get out a note payable for cash. So we're going to be here in P3. I'm just going to say equals, and we're going to pull over the number for that note payable, $135,000. $135,000 on the debit side, $135,000 on the credit side. There is our transaction. We'll go ahead and post that out now. First to the cash. Cash is up top, and we are in U3. We will say equals, and then scroll back over and point to that $135,000. Next, we have the notes payable. Here's the notes payable in the journal entry. We're going to be over here in cell U4, equals, and scroll back over to that credit, $135,000. Back to the information. If we go back to the Capital Projects Fund, now we're in the fund accounting. We're going to record the cash as increasing here as well. And then the other side, normally we wouldn't put the note on the books because the Capital Project Fund, remember, is a short-term flow type of fund. So typically we don't put liability on the books unless it's a short-term liability, because remember, when you think of the balance sheet for the funds, for the governmental funds, then usually we don't break out short-term and long-term, current and non-current assets and liabilities, because they are all current. In this case, however, note that we're saying that we're going to pay it back 2.5 months. So this is going to be current. So we're going to record it. So be careful there, because you have to know whether it's going to be current or not. And that's going to be one of the distinguishing factors as to how the financing is going to work for something like a fund accounting, which is on the modified accrual basis versus what we would expect in normal accrual accounting. All right, so there's going to be transaction, nothing too different here because of that short-termness. And there's the debit and the credit. We'll post it in the same way to the fund. We're going to go to cash first. Cash is up top. That's going to be in K3. We're going to say that that is equal to, pick up that debit and enter. And then the other side is going to go to notes payable. So we're in notes payable. That's in K4 equals. Scrolling back over, we will pick up the credit. There it is. We're back in balance, indicated by the green 0. Next, we have a bond anticipation note. And again, this is another financing form. So we're going to say we got money from a bond anticipation note. Let's first put that into the governmental accounting, and then we'll come back here to the Capital Projects Fund. So we'll scroll over to the right, and this will be another form of financing. So we're going to say we got more money. This is a large capital project we need like a lot of money. So we're going to debit the cash now. So cash is going to increase, another financing format. Cash goes up, and the other side would be doing what we would expect, some other type of liability, because now it's just going to be a bond note or a bond anticipation note. So we're going to say bond anticipation note is the credit. The amounts then are going to be equal to the $430,000 debit and the credit. And so this is going to be meaning we basically expect the bond We're going to issue bonds shortly. We need financing now. Therefore, we're going to take out the bond participation note until we get the financing from the bonds. So we're going to say, all right, there's going to be the debit and the credit. And we're going to go up top and we're going to be in U3. We're going to go F2 plus F2. Go back down and scroll over. I'm just doing this with the keyboard now instead of the mouse, and enter. So we've increased that amount. And then we're going to go to the note payable. Note payable bond anticipation in U5 equals the credit. And there we have it. Puts us back in balance. That'd be a normal type of transaction for another kind of note that we would expect, whether it be short-term or long-term. Cash is going up. Some type of note payable is going up. If we go over to the capital projects then, we're going to do the same thing here. Note, however, that here we're thinking, well, it's a bond anticipation note. So that seems like it's kind of short-term because we're expecting to get financing from the bond possibly soon. But the bond, however, is going to be another form of financing, which is clearly long-term. So at this point, we're going to say, well, since we're basically getting money for the short term in order to carry us over for our capital project until the long-term financing, it's really basically not something we expect to pay back soon. And therefore, we can kind of think of it and treat it more like a long-term type of activity. In other words, on the modified accrual basis, we're not going to put it on the books as a payable as we did with the governmental accounting. So cash is still going up. Cash is cash. We got cash. The other side, however, not going on the balance sheet, we're going to put it into other financing sources. So we're going to put it into other financing sources, which is going to be kind of like a revenue account. It's going to act like a revenue account, but it's not exactly the same as a revenue account, but it's going to be an increase in what we would think of as kind of a net income equivalent. So we're going to say that other financing sources, proceeds from bonds anticipation note. And so that's going to be a difference here between the two, modified accrual and accrual, capital projects fund, and the government-wide activities. So we're going to say cash then is going to be increasing. We're going to scroll up to cash. We are in cell K3. I'm going to push F2 plus F2 so we can scroll back down with the arrows, pick up that 430,000. Next, we're going to go to other financing sources. Other financing sources, bonds anticipation note. We are in K8 equals, and we're going to scroll over to the credit then. There's the credit. We're increasing that. That puts us back in balance. Next activity we have is number 3, where we issue the bond. So now we're going to issue the bond. Again, another form of financing. Let's first do this on government-wide activities, which will be on an accrual basis, which will be familiar to us, hopefully more familiar to us. Notice we issued it at 0.98. So we issued it at less than, we're going to get less money than the face amount, 80 or 98% of the face amount of the bond. Therefore, we issued it at a discount. So this is going to be a discount. We're going to scroll back over to the government-wide activities in order to post this to the general journal. So once again, we're working on financing sources. This is a big project. We need a lot of money. So we're going to say this is going to be cash is going to be increasing once again. Cash is going up for our capital project that we're working on. And then the other side is going to go to a bond payable. So we're going to say, all right, now there's going to be a bond payable that we have. Bonds payable. And then there's going to be a discount on the bonds payable. So there's going to be a discount on the bonds payable. So let's see what this would look like. The bond itself, let's start with that. That's going to be a credit. I'm going to be in Q10. I'm going to say negative to make it a credit. I'm going to scroll back over. We're going to pick up the face amount of the bond, $3,210,000. There is that. Then we issued it at 0.98. So that's 98% of that 3,210,000. Or I'm going to flip the sign by saying negative instead of equal. That number times 0.98. So there's what we got. And that means that there's going to be a discount between the two, which we're going to put down here. It's going to be a debit. Notice I didn't put the debits on top. This is how I would think about it when constructing it. If you need to reconstruct it to put the two debits on top, you can do so if you're dealing with, pickiness of the situation from a software or something like that. So we're going to say negative sum of these items, and there's going to be the discount. So now, of course, the debits equaling the credits. We can post this out. We're going to say cash is going to go up top. So we got the cash. We are in U3. I'm going to do this with the keyboard again. F2 plus F2. We're using the arrows to go back down and pick up that 3,145,800. And then we're looking at the bonds payable. That's a liability. Bonds payable, we're going to be here in U6 equals, scrolling back down to that credit and enter. And the next item is going to be the discount on bonds payable. Discount on bonds payable right underneath the bonds payable. It's going to be equal to, and that's going to be the 64,200. So obviously this minus this, there's the face amount of the bond. Okay, what's this going to look like if we go, and notice obviously there's nothing happening in the what would be income statement account type activity. It's all we got cash, and the other side is going to a liability of some sort, either the bond or the related discount to it. Let's go back over to the capital projects, see what happens there. So we know that cash is going to go up. That's pretty straightforward. Cash is cash. It's going to do what it does. It's going to act the same. And then we're going to have the bond usually goes on the books, but the bond is clearly long-term and therefore not on the fund accounting because the governmental fund, capital project fund, which is in that group, not there because it only deals with the short-term type of activity, so we're not going to have a long-term liability. We're going to put it then to other financing sources. So other financing sources for the bond proceeds. So other financing sources, proceeds of the bond. So I'm going to say enter. And then the other side is going to go to other financing uses. So we're going to say other financing uses. And that's going to be for the bond discount. So we're going to go same kind of process. So now we're going to say, well, this is the account that correlates to the bond going on the books at the face amount. That's going to be negative of, if it's the face amount here. And then the cash is going to go on the books, negative of that times 0.98. And then what would be the discount is now going to other financing uses, negative sum of these items. So you could see that we have to record the discounted item here, because note that the financing of the bond will often be done in the debt service fund rather than here. But because we issued it at a discount, we got less cash than the face amount of the bond, and therefore we're going to have to record the two items to get to the net cash. So we got to record the other financing sources, other financing uses, net out to the actual cash that is going to be received within the project, the capital project fund. So we got those items. We're going to post this out, and also note that we are considering cash flows here. We're recording this amount as a cash flow item and not as a balance sheet financing item. Okay, so we're going to post the cash first. Here's the cash. We're going to scroll up top to the cash. We are in K3. Something's in it. Going to say F2 plus F2. Scroll back down, and we will pick up that number, the cash. And then we have the other financing sources, proceeds on the bond. So here we have the other financing sources, proceeds on the bond. We are in K9 equals, and we will pick up the credit. And then we have the other financing uses, discount on the bonds. So here's the other financing uses, discount on the bonds. We are in K10 equals, and we will pick up the 64,200, and that puts us back in balance. You'll note the activity down here in what would be kind of considered the temporary kind of accounts, similar to what would be like income statement type accounts, those that would close out generally, to what would be the equity section in a for-profit organization fund balance here. All right, let's see what we have next. We are now on number 4. So number 4 says a bond was issued again. And so we're issuing another bond. A lot of financing going on here. We're going to get more money. But this time we're going to issue it at a premium, so we can compare and contrast the discount to the premium. So now we're issuing another bond. We're going to compare and contrast it to the prior bond we had. However, this time we're issuing it at a premium, 101 of the face amount, 101% of the face amount. Let's first do this in the government-wide activities. That'll look more familiar to us. So we are in column O, government-wide activities. Once again, cash is going to be increasing, so we're going to say cash is going up. We've got cash. We've received cash. The other side is going to be a bond payable, so we're going to say bond payable is going to be the other side. You may want to break this out. We could put it into another account. I'm going to put it into the same bond payable account. Probably would be good to be tracking the bonds separately, but I'm going to put it into the bond payable. And then we're going to have a premium on the bond payable. So now we have a premium on the bond payable rather than a discount on the bond payable. I'm going to stack it up in the same way, even though the debits and credits line up a little bit differently. This one will look more normal, where the debit will be on top and the 2 credits on the bottom. We're going to say that first, let's put the bond on the books. So we are in Q14. Going to say negative, scroll back over, and we're going to pick up the bond amount. There's the face amount of the bond. And then we said we issued it at 101. So we're going to go into the cash, and we're going to multiply times 1.01%, 100% plus 1%. We're going to say negative that number times 1.01, 101%. That's how much we got, and then we got more than the face amount, therefore resulting in a premium. So we're going to be on the other side. This will be the plug. This is what I call the plug entry, negative sum of these items. There we have it. So now the credits are equal to the debits, and we can post this out. So here's going to be the cash. We're going to post out the cash then. We're going to scroll back up top. We are in U3. I'm going to say F2 plus F2. Scrolling back down, we're going to pick up that debit and enter. Then we have the bond payable. We're going to put this in the same bond payable. Again, we probably would want to break them out, but that's okay. We're going to put it in here. So F2 plus F2. Scrolling back down, and we'll pick up the bond payable, and then we want the premium on the bonds payable. So premium on the bonds payable, that's going to be down here in U8. Within U8, we're going to say equals, and we will pick up that premium, and there we have that. Notice again, the financing happens. All the financing's up in the basically liabilities and cash section. Nothing's happening down here in what would be similar to the income statement temporary accounts. Now let's see what happens in the capital project fund modified accrual basis as opposed to standard accrual. Here, once again, cash is going to go up, so we're going to increase the cash. And the other side, as before, is not going to be going to the liability, a bond payable, but to other financing sources. So I'm going to put it to other financing sources for the bonds. So there we have that. And what's different then, note that on the other, when we had a discount, we had to record the other financing uses to basically net the two out. This time we're going to say, hey, we issued it, we approved the face amount of the bond, and that's how much we want to use for the capital project fund. If we issued it for more, it basically has to do with interest, and we're going to deal with that amount when with the debt service fund. So this time, what we're actually going to use then is going to be the face amount of the bond. That's what we approved for the use, as opposed to up here where we had the face amount, but then we had to issue it at a discount. So when we issued it at a discount, we then had to use the cash amount that we got, which is less than the face amount. Here we approved the face amount, we issued it at a premium. We're just going to add to the capital projects fund the face amount, deal with the principal in the debt service fund as we deal with the debt to pay off the interest and the principal. So we're going to put this on the books at now the face amount, cash increasing, and the others going from other financing sources, proceeds on the bond. Okay, so let's record this out. We got cash up top. We're going to go up to cash. We are now in cell K3, F2 plus F2, scrolling back down. We're going to pick up that debit and enter. Then the other side is in other financing sources with the proceeds on the bond. We are in K9, F2 plus F2, scrolling back over other financing sources and enter. So that puts us back in balance. And let's see what else we have. We got the final item here, I believe, number 5, which says we have a construction-related bonds sold. So now we sold bonds that were related to our construction process here. So once again, another form of financing we have. We got this large project we're financing here. The difference here is that we have 2 months of accrued interest and the interest rate at the 4%. So let's see what that's going to look like. Let's do it first on the government-wide type of activities on the accrual basis, which will be familiar or more familiar to what we would expect. We know that cash is going back up because we're doing the financing for our project. So we're going to say cash, that then increasing. We've got bonds payable. Once again, bonds payable is going to be increasing. That's going to be a liability. I'm just going to put it into the same bonds payable here. And then The other factor we have here, the new factor, is that we have accrued interest because we had 2 months of this accrued interest. So that's going to say we're going to have this liability of the accrued interest that we're going to have to pay on this. So that's going to be another liability type of account. Let's start off with the bonds payable. That's going to be the easier thing to do. So I'm going to say this is negative in Q18. Scrolling back over, and we're going to pick up that 3,130,000, 3,130,000. Then we'll calculate the interest. It was at 4%. 2 months have passed. So we're going to say this is how I would do it, at least 3,130,000 times 4%, 0.04. That would be interest for a year. We only have 2 months. So I would break the yearly interest to a monthly interest dividing by 12 months. And that gives us the monthly interest. We had 2 of those months times 2. So that's how I would think of it. Some people would break out the interest. By the way, they would say 0.04 is the interest. You could say divided by 12. That's going to be the monthly interest rate times 2. There's the interest rate for the time period we're talking about, 2 months, and then multiply that times the 3,130,000, and that's going to give us our same number. So let's go ahead and do that. So I'm going to say negative just to flip the sign. I'm going to pick up this number. That's going to be the amount. I'm going to do this with a formula. And then we're going to say times 0.04, the percentage. I would divide that by 12 to get it to a monthly amount, and then multiply it times 2 for the 2 months that have passed. And there we have that, but I want to make it a negative number. So I'm going to delete this. Okay, there we have it. So I deleted the negative sign because this number is negative. So, okay. So now we're going to say that the cash is going to be the negative sum. This is the plug formula of these two. So we got the 3,150,867. So let's post this out. So here's going to be the cash. We're going to scroll back up to post the cash. So we'll scroll back up. We are in U3. I'm going to say F2 plus F2. Scroll back down. And we'll pick up that 3,150,867. And then the bonds payable is next. So I'm going to post the bonds payable next, which is this item. So we'll scroll up to bonds payable. That is in U6. Within U6, we will say F2 plus F2. Scrolling back down, we want to pick up those bonds payable and enter. And then finally, we have the interest payable. Here's the interest payable. We want to put that into the interest payable here. Nothing is there. We're just going to say equals and scroll down to that interest payable, which is that credit, and enter. There we have that. Once again, financing happens. Nothing going on with the income statement account, those temporary accounts, the ones that would close into what we would think of as the equity accounts or net position in the case of the government-wide funds or activity. So now we're going to go back over, see what happens to the capital projects fund. So the capital projects fund, we got cash is cash. It's going to go up. So same kind of activity there. However, the amount that we're going to use is just going to be the, once again, face amount at this point, because the face amount plus the accrued interest would be higher. We're going to deal with the interest in the debt service fund and just allocate the face amount here to the capital project and deal with the financing of the interest debt service fund. All right, so we're going to put this amount up. And then the other side then is going to go to other financing sources, proceeds of bonds. And so we don't have the liability because this will be long-term liability. We're focusing on the flows here. Therefore, we're going to put it to what would be similar to the income statement accounts. Let's go ahead and post this. Here's going to be the cash. So we're going to scroll back up. We've got cash up top. We're in cell K3, F2 plus F2. Scrolling back down. We're going to pick up that cash amount. And then the next one we want is going to be in the other financing sources. So other financing sources, proceeds of the bond. We are in K9, F2 plus F2. Scrolling back down, we're going to pick up that credit and enter. So there we have that. That puts us back in balance. So there we have some of the different types of financing options you could see, and you could see the differences that we're going to be recording to the capital project fund, tracking short-term activity, as opposed to the government-wide activity, more what we would expect on the accrual basis.